Okay, now let's say we want to augment our mean variance optimization by incorporating the economic balance sheet, all right? So you learned about this earlier where we talk about, we want to include things like human capital, right? Because that's certainly a very valuable asset that we can get an estimate of the present value of, get a sense of how that impacts what we need to do with our portfolio. So if we include that human capital, let's say that client works in a career path that's relatively low risk. We feel that wages are going to grow in a fairly stable fashion. Well, and we can look at this and say, this, human capital, view this as like an asset similar to an inflation-linked bond. Basically, we expect it to be increasing in value in a rate that matches inflation. Otherwise, we can model it as a mix of an inflation-linked security and corporate bonds plus equity, basically depending upon what we think sort of the volatility of that career path may be. Basically, just trying to approximate the cash flows that that person expects to be earning and the riskiness of those cash flows over time as a way that we can incorporate that into the mean variance optimization. Residential real estate can also be included in there, right? We're not just talking about the financial assets, but also the harder assets like real estate, tangible assets. And so what we can do there is to try and pull some time series data from a property index to try and estimate what the expected return and standard deviation would be. Obviously, the best way to do that is to tie that index value to their location. If they're living in a relatively large metro area, well, then you have a greater chance of getting good data on that. If they live in a more remote area, well, it's going to be a little bit more of an educated guess. And so with all of this, with human capital, with residential real estate, what we can do is we can also include this in the optimization and basically constrain it to a current percentage allocation if we wish. Okay, so let's also talk about liquidity issues. There are asset classes that require a liquidity premium. So for example, direct investment in real estate. You buy a house, if you need to sell it, it's not going to happen at the drop of a hat. If you have investments in alternatives like private equity, hedge funds, venture capital, any investment in infrastructure, those are things that are illiquid, they require a liquidity premium. And so what that means is that it makes it a little bit more difficult to model for mean variance optimization. Basically, if we have asset classes that are hard to liquidate or hard to trade, that's going to make the correlation with other asset classes, well, that measurement quite often is going to be thrown off, right? So it makes it more difficult to model. It also means that, in our efforts to try and ameliorate this, if we're trying to find indexes that we can use that, we hope to have sort of more robust data on, well, those are pretty hard to find. We also have a lack of low-cost passive investment options with less liquid asset classes. And as a result, by having these, well, it often creates in our optimization a concentrated risk exposure, which means we run the risk of having idiosyncratic risk. We're just not simply well enough diversified. So it's hard to diversify within the asset class, and then it also creates an issue with diversification in the mean variance optimization. So if we want to model these illiquid asset classes, well, one thing we could do is to just say, let's exclude it, okay? Let's say we have a current position in private equity, all right? We're going to retain this existing position as part of the total portfolio, and then we'll use mean variance optimization on the rest of it. That's one way to sort of work around the problem. Another thing we can do is say, yes, we're going to include it. We need to have the whole picture here. And so what we need to then try and do if we're going to put it in our mean variance optimization and have that optimization work properly, well, then we're going to have to do a little bit of work on that asset. In other words, do some work on the data itself. So we need to try and model the characteristics of the specific assets held, right, of that illiquid asset class. We're going to try to model the characteristics of the asset classes using alternative investment indexes. So we're going to take the data that we have, the investments that we have, and then try and use data from other sources to try and give us a better model of expected return, standard deviation, and correlation with other asset classes. And so what we're going to try and do here is try and create kind of a mosaic almost. We're going to take this illiquid asset class, try and make a conglomeration using data from other asset classes, and use that hopefully as what we think is a better approximation of mean, standard deviation, and correlation that we can then feed into our mean variance optimization and have it work properly. Okay, next thing. What if we have certain client issues? Well, client issues certainly crop up, and what that means is that it may impose additional constraints on the portfolio. So, for example, we may just simply have a client, let's say this is an individual, that looks at a portfolio that you say, boy, this has a great Sharpe ratio, you're getting really a lot of bang for your buck, but they look at it and say, it's 85% invested in equities, I'm a little bit scared of equities. I don't want to put more than 70% in there. So you may just simply have to limit the allocation of risky assets despite the fact that your optimization tells you that that's what the weight should be. So quite often it's going to come down to some form of a ceiling, some form of a constraint or a cap on portfolio risk, whether it's the percentage invested in a particular risky asset class or maybe a standard deviation maximum. Now, we could also try and capture this in a utility framework by trying to specify that risk aversion factor. So if the client is sort of presenting these concerns to you, well, then that's a sign that, yeah, their risk management or their rather risk aversion parameter lambda maybe is higher than what you originally thought. Now, another thing you can do is to try and do this with Monte Carlo simulation. So if your mean variance optimization calls for allocations to risky asset classes that make that client nervous, well, okay, maybe then you would say, all right, well, let's do some Monte Carlo simulation, basically. And what we're going to do here is to show the client, all right, if we start today with this level of wealth and we invest in the portfolio that we are recommending to you, let's run simulations about what the final result will be. And so what you can do is show them a distribution of ending wealth after a certain period of time. If they look and they see those results, and they see that, okay, if things do go badly, what's the worst that could happen, or what's the lowest probability result? Well, then that actually may help sort of mitigate their concerns. They may look at that portfolio and say, oh, that's a lot of money to be putting into equities or a lot of money to be putting into risky assets in general. You can say, but look what's going to happen. We ran this simulation 10,000 times. Here's what happened on average. Here's what happened at the 5th percentile, the 95th percentile. And so they can look at that, and maybe they'll look at that and say, okay, yeah, I can live with that. All right, so that Monte Carlo simulation, right, it's a statistical modeling tool or complementing the mean variance optimization. So here's the nuts and bolts of how we do it, right? So basically we run multiple simulations. I chose the number 10,000. That's actually quite easy to do with our computing power in this day and age. We could do it millions of times if we wanted to, but you can actually do 10,000 simulations of Monte Carlo in relatively short amount of time, right? A span of a minute or two, or even faster if you have a faster computer. So what we're doing here is we're assuming that we have some of these distributional aspects of our asset classes. So we typically need to say, all right, this is going to follow a normal distribution with this mean, this standard deviation, this correlation. If we've got a more powerful statistical package, well, then maybe we can include some non-normality assumptions in there. Basically, we have some rules for rebalancing over time that as we look through each period of the model, if we look at the returns of stocks versus bonds versus real estate versus alternatives, if that stretches the portfolio weights out of a certain range, well, then we have a built-in assumption where we rebalance to go forward. So we have to put that assumption built in there. We can also include things like expected inflation, your expected tax rate, your consumption during that period of time. And then each time we run this simulation and get to the end of the timeline, that can be the result of one scenario. So then we do this. We repeat this many, many times with different expectations of returns and standard deviations, different results from those assumptions that we make, and each one gives us a different scenario. And so what we do then is that we get a final result of this. We get basically, whether we run it 1,000 times or 1,000,000 times or anywhere in between, we get a distribution of final results. All right? So let's look at an illustration. The following chart shows a client age 50. Want to retire at 65 and have the portfolio be worth no less than its current value in real terms. So their portfolio is worth $1 million today, and so we want to say that portfolio doesn't want to be worth any less than $1 million, for example. 300 simulations of the asset allocations results were ranked to display portfolio real value at the 10th, 25th, 50th, 75th, and 90th percentile over time. So again, we looked at the allocation, looked at the expected returns, standard deviations, correlations, ran the result of the portfolio over those 15 years. The end result at the end of those 15 years was one scenario. And then they ran 300 of these scenarios to create a distribution of those final results. All right, so that's what this looks. This is what that looks like. That illustration that we see here, that graph is the output. Okay, so we start at the left-hand side. They start with a portfolio worth $1 million. Okay, and then basically each one of those bar charts is showing us where that portfolio value went. Okay, so in the 90th percentile, right, towards the top of the distribution, basically that portfolio went from $1 million to $5 million. All right. In the 75th percentile, it went to about $3.3 million. The median, the 50th percentile, it went from $1 million to about $1.9 million. And so as you go down even further, basically you have to go all the way down to the 5th percentile to where you find a result that actually ends up with an ending value that's less than the beginning. So if you look at the 25th percentile, basically they break even using that portfolio allocation. So if they end up in the 25th percentile, a little bit unlucky, they would end up just barely above what they started with. So if you go below the 25th percentile, well then yeah, that would be the scenario, that range, where they would end up with less than what they started. So you can show this to the client and say, okay, 75% of the time, you will be at or exceeding your initial value as your ending value. Maybe as high as $5 million or more, maybe only $1 million, but only 25% of the time are you going to end up with less.